is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. China's consumer spending and industrial activity disappoint in April, calling into question the strength of the economic recovery. Debt talks in Washington. Treasury Secretary Yellen says the U.S. is already paying a price for the stalemate. Plus, sterling drops on signs that the UK labour market may be starting to cool even as wage growth accelerated again in the first quarter. Well, good morning, everyone. Let's check in on the markets. A lot going on as we saw a little bit of a reversal. British pound firmly in focus. Some of the other things that we're watching out for is, of course, equities in general. Now, we did see a bit of a reversal because we saw some pressure, and now we're seeing a bit more of a catch-up. Certainly the DAX now gaining 0.2%. We had the Japanese stocks rally and pound weaker, so we'll have a full roundup of some of the UK news. Oil demand will rise more than expected on the rebound from China. We're just getting some breaking news out of the IEA. This, of course, not only could move the price of oil, but it could also have an impact on what dollar does. Oil demand, again, they're expecting it to rise more than expected. This is their annual report. They're expecting world fuel consumption to increase by 2.2 million barrels a day in 2023. And if you understand what the agency is also predicting, they believe that as demand accelerates and the OPEC Plus alliance led by Saudi Arabia curbs supplies, then you could see global oil markets actually remaining on track to tighten sharply in the second half of the year. You can see for the moment, crude oil, NYMEX 71.46, and crude here at Brent, the London market, $75.63. Now, in a couple of minutes, we'll also speak exclusively to the IEA's head of oil markets, Toril Bosoni. Then, fresh data out of China suggests that recovery in the world's second largest economy is losing momentum, although we saw a bit of a mixed signal. Consumer spending and industrial activity grew at a slower pace than expected in April. The youth unemployment rate also surged to a record high of just over 20%. Well, we're now joined by JP Morgan Chase Global Rates Portfolio Manager Kim Hutchinson. Kim, great to have you on the program today. There's a lot going on, what we're expecting actually inflation to do, and in general what the markets are pricing in. What's the biggest unknown right now, what the Fed does?
For the Fed? So I think what the Fed told us that May was their last hike. You know, their game plan from here is really to pause and wait and see for the rest of the year. They removed their implicit hiking bias. They told us that policy rates are currently restrictive. They are causing credit conditions to deteriorate. Powell, even without looking for a recession this year, also told us that we're basically nearly there, if not already there. So we think May was their last hike. So we looked at the last 7 hiking cycles as well, going back to the 1980s. You know, how long did that take from the Fed's last hike to their first cut? That on average was 6 to 7 months. Yeah. So if May was the last hike, that takes us to the end of this year. We do think there is some reason to believe that it could be quicker this time, just because of the sheer pace and magnitude of the hiking cycle.
But, okay, so we just have this IEA saying, look, oil demand will rise more than expected on the China rebound. When you look at also what the market is pricing in with, for example, the Fed cuts, which a lot of people are pushing back and saying, look, it's just too soon to see cuts this year. Does a rebound in China, fall into that equation that we could still possibly avoid a recession?
I think what we saw from the China data this morning is that it is softening. Chinese government bond markets priced a lot of that in already coming into April. So we didn't see a big move there. But we know that this growth story in China that's coming this time, it is very consumer services led, which is domestic. So the spillovers are smaller into the rest of the world. So we don't think that's going to be a big driver in terms of whether we go into a recession in the US or not. It's more going to be the domestic growth and inflation data there.
So how do you construct a portfolio in this kind of environment?
Yeah, so the markets have really been coiling in the last month, not doing that much. As you mentioned earlier, there's a lot of cuts already priced in for the Fed as soon as July. We think a cut could come as soon as September instead. But you still got to be in those end-of-cycle trades. So looking for lower yields, steeper curves, high-quality duration. May was probably the Fed's last hike, and history tells us to buy the last hike. We like owning duration in the US the most. You get the added tailwinds that you come from tensions around the debt ceiling that's still ongoing, regional banking stress that could re-emerge. So we still like duration. I think The way you square that circle with being afraid that the data is going to be a bit stronger near term and pushing those cuts further out is just to own more duration in the belly of the curve.
So when you look at, is that across the board? Is that in the US? I don't know if you look region by region and whether you make differentiations.
Yeah, so we do like US duration the most, but the UK market is one that we're actually thinking is starting to look quite attractive from a valuations perspective as well. So it's a good diversifier in your portfolio. Inflation is still very persistent. It's probably got one of the most persistent inflation problems among the developed markets, but those valuations have also repriced significantly this year. We like to look at, for example, where the 10-year UK yield is trading versus Germany and the US. And that spread is at levels that we haven't seen since 1997, putting aside the trust period that we saw. So I think that's a good long duration diversifier to start edging into.
Yeah, Kim, when you look at the UK, and I don't know how actually, concretely, apart from how you just say you play the UK and what you make of the data out today, like if we start seeing quite a big hit on the labour market, how does that change your equation?
Yeah, so I think it's important to put some context around that. Last week, we saw the Bank of England give us hawkish forecasts. They really shifted up their growth and inflation forecast. They kept their tightening bias intact. But then the communication in the press conferences after were also a lot more dovish. And if we look at the labour market report today, we did see tentative loosening in the labour market, which is good news for the bank. But wages are still at 7%. Participation rate did tick up. But now we're left with the highest number of people who are out of the workforce because of long-term illness. We know those people aren't coming back that soon. So you could argue that the participation rate has probably reached its limit in terms of how much it can rise significantly in the near term. So I think the Bank of England's still stuck. There's still more data to chew before the June. You get one more labour market print, 2 more inflation prints. So we'll have to see how that data develops. We do think there's going to be enough inflation fuel in the tank for the BOE to still keep their foot on the pedal and give us some more hikes.
So where do we end up by year end?
Yeah, it's a good question. I think they're going to give us 2 more hikes to get to a 5% terminal rate. There could still be a lot of strength in the UK economy over the summer. Then when they hit 5%, they can then pause, take a look at the data. And then, of course, it depends as well what the Fed is doing in the tail end of this year.
Kim, when you look at the Bank of Japan, and this is probably the most interesting financial experiment of all times, I mean, do you see value, or are we still in a wait-and-see situation because we don't 100% know what the governor will do and whether he'll be able to do what he's announced?
Yeah, so I think the inflation narrative is definitely changing in Japan, and the Bank of Japan is taking note of that. They are talking about upside risk to inflation. So you've got core at about 3.8%. The breadth of those pressures are also broadening, which is important. However, we don't think rate hikes are a story for this year. Them letting go of yield curve control policy, though, probably is, which is why we still like to sit short 10-year Japanese government bonds, just on that chance that they will release that this year.
All right, wonderful. Thank you so much for joining us. That was JP Morgan Chase Global Rates Portfolio Manager Kim Hutchinson with the very latest on the markets. Now, coming up, an exclusive interview with the IEA's Toril Bosoni on their latest oil market report. That's coming up shortly, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, global oil demand will climb more strongly than expected this year. That's the view of the International Energy Agency. It says world fuel consumption will rise by 2.2 million barrels a day, helped by China's post-pandemic rebound. Now we can speak to the head of the IEA's oil market division, Toril Bosoni. Toril, as always, thank you so much for giving us a little bit of your busy schedule. Now, if you look at the stronger demand or the stronger demand growth that you're seeing in the report, I know that's also from a weaker assessment of previous years. So overall, how would you describe the report? Is it as strong and bullish as maybe some of the places in the markets are taking it?
Yeah, good morning. Yes, what we're seeing is we're really seeing really strong demand, especially in Asia at the start of the year. Chinese recovery has been faster and stronger than expected. And in March, Chinese demand reached an all-time high. Indian demand is also very robust, and we're seeing very strong growth also in the Middle East. And this is contrasting with the sort of the economic gloom and the concerns that we're seeing for the world economy, from industrial activity, and especially in the OECD, where demand has been relatively weak over the past quarters. But we are expecting strong growth this year. In a context where supply is set to fall through the rest of the year, that might again put the market and prices under pressure.
Toril, we also saw a bit of weaker Chinese indicators. Would you say that risks are, though, to the downside?
Yeah, so as you said, a lot of the indicators for China, especially on manufacturing and industrial activity, has come in weaker than expected in contractionary terms. But we're seeing for personal mobility, the service sector is holding up strongly, not just in China, but globally, pushing up gasoline demand, jet fuel demand. The recovery continues. So there's a two-tier markets on the demand side that we're seeing, and obviously concerned about the relative weakness in manufacturing and industry, if that would translate into lower GDP than forecast for the remainder of the year and actually push down demand growth compared to expectations.
Given all the economic headwinds out there, are you still confident, actually, that the market will tighten pretty significantly in the second half of the year?
So we're obviously watching very carefully. The economic picture has deteriorated. Interest rates remain high and rising. Inflation is running high. And there is concern that we are going into contractions in many areas. But we're looking from the low baseline of last year, when Chinese demand was contracting due to the restrictions that were in place, when aviation and travel was still constrained. We are expecting demand, but we're expecting very little demand growth in the OECD. For instance, in 2023, the OECD, so including the US, the Eurozone, Japan, Korea, is growing only by about 350,000 barrels a day. And that's in stark contrast with about 1.9 million that we're expecting for the non-OECD countries. So it's a market of two halves, if you can put it that way. But we are expecting demand to continue to recover.
Toril, when you look at supply cuts that were put in place by OPEC+, there was a big concern that this will bolster prices and hurt consumers. That hasn't really happened. With hindsight, did OPEC+ actually do the right thing?
Well, those cuts haven't really taken effect yet. They're coming into the market starting from May. But already in April, we saw oil supply fall. There was significant losses from Iraq, from Nigeria, from Brazil, other countries. But this is also coming at a time when seasonally refinery activity is weak and demand is weak in between the winter and the summer season. So it would be interesting to see now when further supply cuts starting this month, not just from some of the OPEC+ countries, but also from Canada, where wildfires are shutting in production. And you have the seasonal ramp up both in refining demand and in driving demand in the Northern Hemisphere, how the market would rebalance, and if we do see renewed inventory draws starting this month and the next.
OPEC+, I think, are meeting again at the beginning of next month to try and review production. What's your message to them now?
OPEC decision is obviously for them to see. But we're also watching carefully the market and how things are rebalancing. There is a lot of uncertainty out there, not just about the pace of oil demand, but the global economy. But I think OPEC+ meets at monthly levels, monthly meetings. So obviously, we've seen that they're adjusting their production regular basis. So if the market tightens, we hope that they adjust their forecast or their ceilings as needed.
Yeah. Toril, in your report, you also talk about the dip in refining margins globally. Is that going to impact demand for oil worldwide?
What we saw a very sharp contraction in margins indeed, and that's led by the much lower diesel cracks. But what we saw is that a lot of refiners in Asia, both in China, India, that have access to discounted Russian crude, has been processing record rates during the first quarter at the start of the year. That has helped ease some of the tensions on the product markets. And so going forward, again, on the refining side, we're seeing activity shifting east, continued shift. There's new capacity starting up, but also those that have access to discounted Russian crudes have a better margins than the benchmark margins that we see elsewhere. But if we do see industrial activity and gas oil demand remaining weak, we could see some of the refining activity in Europe, also in the US, lower than earlier expected, and we have reduced our forecast for activity in those areas for the rest of the year.
Toril, thank you so much. Toril Bosoni, there, head of the IEA's oil market division, with, of course, the report out this morning. Now, coming up, another warning from Treasury Secretary Janet Yellen on the debt ceiling deadlock after House Speaker Kevin McCarthy says they're nowhere near reaching a conclusion. We'll have plenty more on the debt ceiling debate shortly. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. China's consumer spending and industrial activity grew at a slower pace than expected in April, adding to signs the nation's economic recovery is losing momentum. Industrial production rose 5.6% from a year earlier, much lower than the near 11% expected by economists. China's youth unemployment rate also surged to a record high of 20.4%. Now, Turkey is set for a runoff election, with President Erdogan falling just short of enough votes for a first-round victory. Erdogan won a 49.5% of the vote, with the main opposition, a challenger, gaining just under 45%. The need for a runoff election to be held on the 28th of May suggests a more divided electorate than in 2018, when Erdogan won in the first round. Now, Elon Musk has responded to news that he was subpoenaed by the U.S. Virgin Islands and the J.P. Morgan Epstein lawsuit. In a court filing, the U.S. territory said it had a reason to believe Epstein referred or attempted to refer Musk to J.P. Morgan as a client. In a tweet, Musk says the notion that he would listen to financial advice from Epstein was absurd, adding that he never advised him on anything. Global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. Now, Treasury Secretary Janet Yellen has warned that the U.S. is already paying a price for its failure to raise the debt limit. Negotiations resume later today, but the House Speaker, Kevin McCarthy, says talks to avert a historic U.S. default are nowhere near a conclusion. Now, let's speak to Bloomberg's Bill Ferries. Bill, thank you for joining us. So what are the chances of a breakthrough today? 0 or 2%?
I think it's slim when we're still a couple weeks away from what's believed to be the earliest deadline for the debt ceiling to be reached. But what Kevin McCarthy said in his letter was that the staff level talks that have been taking place over the last week or more have really not made any progress at all. This is the last chance for McCarthy and Biden to speak before the president is scheduled to leave on a trip to Asia on Wednesday. So I think both sides are going to see whether they can make enough progress to get the staff back working a little more effectively, with early June being still the expected the deadline, or when the debt ceiling will be reached.
So how much longer can this go on for?
Well, Janet Yellen, she's expected to give another update on when she thinks Treasury will reach that debt ceiling. We've heard it will be probably early June. It could be June 1st. But the reality of Capitol Hill politics is that any legislation to raise the debt ceiling would need to be moving through both houses several days before then. There are just some things that are very hard for that are hard to speed up when it comes to writing and passing legislation. And the timeframes allowed for debate. So they need to, if June 1st were the date, they need to be having legislation moving perhaps 4 or 5 days before then.
Bill, I mean, are there any sticking points that they can actually work on, or is this going to be an 11th hour kind of agreement because the markets go crazy?
Well, when we've seen this in the past, and we've seen it many times in the past, it's always a last-minute agreement. The Republicans are trying to make some changes. They want to see some spending cuts. Democrats are proposing in return closing some tax loopholes. For Republicans, closing tax loopholes is seen as a tax increase on the people affected, and that for them is a red line. So both sides, although they're putting things forward, seem very far apart.
Bill, thanks so much. Bill Ferry's there on the U.S. debt ceiling. In the meantime, we're also looking at some of the exceptional things we're seeing on the markets. Now, European stocks and U.S. equity futures, I think, both declining now before this other round of talks in Washington aimed at ending the debt ceiling stalemate. Then we also have a renewed push by Japan's corporates to increase buybacks and focus on returns and helping boost sentiment in Asia. That's not quite translated here in Europe. Coming up, the latest data shows some tentative signs of weakness in the UK jobs market. This is Bloomberg. China's consumer spending and industrial activity disappoint in April, calling into question the strength of the economic recovery. U.S. futures fall ahead of more debt talk in Washington. Treasury Secretary Janet Yellen says the U.S. is already paying a price for the stalemate. And sterling drops on sign that the UK labour market may be starting to cool, even as wage growth accelerated again in the first quarter. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, UK wage growth accelerated in the first quarter, suggesting let-up in the inflation pressures worrying the Bank of England. Now, average earnings, excluding bonuses, rose 6.7% in the 3 months to March compared with a year earlier. Joining us now is our Bloomberg UK correspondent, Lizzie Burden. So, Lizzie, how have the BOE bets changed? If you look at the labour market, sure, it's softened, but if you look at what we're paying workers, it's still above 7%.
Yeah, so to break down the market reaction, as you say, BOE bets fell initially and the pound fell against the euro and the dollar, some of that fading since the release. But it seems that markets were really focusing on the payroll number. And economists say you really have to treat that with a big dollop of salt. It's usually subject to revisions. They also seem to have been reacting to the dovish commentary from Hugh Pill yesterday, the chief economist of the Bank of England, saying that he hopes the bank's near the end of its tightening cycle, and that's really the clearest sign yet that we are. But for economists, the commentary has been slightly different. They focus instead on inactivity falling. They say that, yes, unemployment was expected to hold steady, but it's ticked up. And wage growth, as you point out as well, wasn't as high as expected, but there is still an increase. So as the morning goes on, really, economists and markets converging. And the bottom line is the labour market is still tight, but it's showing signs of cooling.
So, Lizzie, what does this mean for the government?
I mean, we know that Rishi Sunak's #1 priority is halving inflation by the end of the year. So any sign that he could make that happen is going to be welcomed, not though that unemployment has ticked up. But the worrying number today for the government is that the number of people who are economically inactive because they're long-term sick is at a new record high. Now, of course, another of Rishi Sunak's top 5 priorities was cutting NHS waiting lists. And he's not going to be helped by the fact that another number in all of this is that the number of days lost to industrial action is climbed again. And that includes, of course, doctors and nurses. Now, we've already seen strikes weighing on GDP. This could be adding to the economic inactivity problem. So they all feed in together, and it really puts pressure on the government to settle those strikes with the unions.
Lizzie, when you look at the labour market, and someone from JP Morgan was making actually that point about 20 minutes ago, because we understand that so many people have left the workforce because of long COVID or for various reasons, because of the pandemic, how difficult will it be to get them back in? So is the labour market still just structurally stuck in the UK?
I mean, this is the headache for the government at the moment, in particular Mel Stride, the Work and Pensions Secretary. So in the budget, they already did these childcare reforms, pension reforms. The good news is that you can see students coming back to the workforce. That's what's driving this reduction in economic inactivity. But in order to get the long-term sick back, you need to reduce the NHS waiting list, which is why I say that the doctors and nurses striking is a difficult problem. The other approach that the government may want to take is, you had Mel Stride saying that potentially they could cut income tax if people come back to the workforce. That wouldn't necessarily solve the same problems that childcare could, in the sense of closing the gender pay gap and growing the economy. So you have to ask, when money's tight, how does the government want to prioritise the way it's going to do this? Yeah,
and how do they grow? Lizzie, thank you so much. Lizzie Burden there, our UK correspondent. Now, Trader is also pricing in another 25 basis point hike at the next Bank of England meeting in June. The former governor, Mervyn King, says COVID and the war in Ukraine have thrown curveballs at the central bank. He says the BOE should not be making such precise forecasts.
The circumstances of a pandemic and what's been happening in Ukraine mean that it is foolish to try to pretend that one can forecast accurately. That's far too precise. We do not know enough about the future to make those forecasts. So what we need to do is to identify risks.
Former Bank of England Governor Mervyn King there speaking to Guy Johnson. Now, the chief executive of the London Metal Exchange also says the resumption of nickel trading in Asia hours has pushed up in volume, but not back to the level before the crisis in March 2022. Matthew Chamberlain spoke to Bloomberg's David Inglis in Hong Kong.
27th of March, we reopened Asian hours trading for nickel after the nickel events of March last year. We're really pleased about that. You know, it's just nice to wake up in London, turn on my screen and see that there've been 500, 600 lots of nickel traded. And I think that's really indicative of how important this time zone, this geography is to our contracts. We're really pleased about that. And actually, if I look at nickel generally, April, which is our first month with the Asian hours reopened, volumes full month, full month, outright volumes up 10% on the prior month, 60% on the prior year. Obviously, that was just after the events of March. But it feels to me like we're building back.
What was pre-pandemic Asia hours nickel, just for context? I guess so. It's 500, 600.
So you'd normally see over 1,000 pre-pandemic. So not back there yet, and not back there yet with the entire contract. But it's this process of rebuilding trust.
Well, I was going to get to that reputation. Do you think you've managed to salvage that completely? Like, that's an abstract concept, obviously. Where are you on that conversation?
We're very conscious that trust is something that takes a long time to build or to rebuild. But I would like to think that our market believes we're doing the right things here.
I want to start with OTC sort of transparency. How has that been received, over-the-counter sort of positions?
So there's always going to be a tension here, because understandably banks don't want to reveal their OTC books. But I think there was a real feeling after March 2022 that as a community we needed to come together to stop this kind of thing happening again. And that's why we put in place the OTC reporting requirements. And I think people have taken them in the spirit that they're intended. We're not gathering that information for commercial purposes. We're not gathering it to try to bring it on exchange. We're gathering it purely so that our market surveillance colleague can have a comprehensive view of risk. So I'm really grateful that people have taken that, as I say, in the spirit it was intended, and I think it's working well.
Well, that's the Chief Executive of the London Metal Exchange, Matthew Chamberlain, speaking to our David Inglis in Hong Kong. Now, we'll be covering all things UK every week on Thursdays at 9:30 a.m. UK time. In our half-an-hour special this week, we're joined by one of the UK's most prominent financiers, Guy Hands. Coming up, billionaire bets, investing titans load up on AI stocks. We take a look at what's in and what's out from the latest 13F filings. That's next, and this is Bloomberg.
Bloomberg has the Fed coverage you're looking for. Today, an exclusive interview with Richmond Fed President Thomas Barkin.
Everybody's got a recession playbook, and the reason they haven't turned the pages is that their business actually remains pretty sound.
Then Bloomberg's Michael McKee speaks with Chicago Fed President Austin Goolsbee.
We should gather further data, and we should be extra careful about raising rates too aggressively.
The most in-depth coverage and analysis of the Fed, right here on Bloomberg, your global business authority.
Now, the latest 13F filings show Michael Burry, the money manager made famous in The Big Short, now has a big long when it comes to China. Now, for more, let's bring in Bloomberg's Valerie Teitel. Valerie, he basically fully loaded up on JD.com and Alibaba. Unexpected, frankly.
Yeah, well, so he's been building a position in Chinese equities since late last year around the China reopening narrative. But in the first quarter of this year, he has tripled his exposure to JD.com and doubled his exposure to Alibaba, taking China tech. 20% now of his 50 billion portfolio is now exposed to Chinese tech. And, as this tech trade heats up, there's a lot of discussion of whether U.S. is going to outperform Chinese tech. Michael Burry is clearly in the China camp. He only actually has one U.S. tech holding name, and that's Zoom. But it's really taken over by his massive holdings in these Chinese tech names, especially Alibaba and JD.com.
Yes, we love going through these 13F filings because it basically gives us an inside glimpse into what these big hedge funders are looking into. If you look at, AI is a big bet for almost everyone.
Yeah, so especially when it comes to the family office's name, that's David Tepper's Appaloosa and Drunken Miller's Duquesne. Both showed quite a sizable position building in AI names, one of them being NVIDIA. Both of those funds increased their exposure in the first quarter. And Tepper's fund made some new positions in Cathie Wood's ARK Innovation Fund. And then when it comes to Drunken Miller, he invested quite largely in Microsoft last quarter, who is an investor in OpenAI who holds ChatGPT. He also invested in a healthcare AI company and Alphabet. Those were of his new positions. But it seems like the NVIDIA holding that they're building, NVIDIA has been a stock that has gone up almost 100% in the first quarter. It's been really a beneficiary of this AI buzz. But, in these 13F filings, we only know their holdings at the end of the first quarter. So it's a bit unclear whether they're chasing the trade or hopefully they were in it from the beginning of Q1 and benefited from it.
Yeah, also unclear to me actually whether Burry, so he made his name as a contrarian, right? This is all, we know it because of 2008 and some of the bets that he took in subprime there. Is this because he's bullish on China, or he just thinks that the fears on China have been overdone?
Well, look, the fears on China have really only escalated in the past few weeks when the Chinese data has soured. If you go back and see when he initiated these positions, it was clearly just bullish on the China reopening narrative, which has been thrown a bit of cold water on when we've gotten some sour data like the data we got overnight from China. But he is a bit contrarian, especially when it comes to his holdings of U.S. regional banks. The 13F filings showed that he held First Republic, PacWest, and Western Alliance. Now, that stands at a bit of a contrast to what we've heard from Warren Buffett, Berkshire Hathaway, who's kind of soured on the U.S. regional banks. And the 13F filings there showed that Berkshire actually exited their positions totally of BNY Mellon and U.S. Bancorp.
All right, thank you so much, Valerie Teitel there with the very latest on some of these 13F filings. Now, Fed rate hikes and negative social media sentiment helped cause Silicon Valley Bank's collapse. That's the view of the company's former chief executive officer. Greg Baker submitted the comments in writing ahead of a U.S. Senate Banking Committee hearing later today. Now, SVB was seized by regulators in March, with its failure setting off a number of other bank runs. Well, Stefania Bianchi, our senior finance editor in Dubai, joins us now. So, Stefania, tell us a little bit more about what Greg Baker said.
That's right. As you say, Francine, he's saying that comparisons by the media between SVB and Silvergate Capital, which announced its plans to wind down just a few days before what happened with SVB, that they all contributed to its failure. And, discussions and rumours online really led to this unprecedented bank run, which we now know led to its collapse.
So what is a wider impact of his written testimony?
Well, look, I think since the collapse of the likes of SVB and Silver Capital, executives have really been under pressure at these failed banks to really understand what went wrong. So I think people will be watching this hearing closely to really get more details of what went wrong and what could have been done to prevent these collapses and then potentially any future collapses that may come in future months.
So, Stefania, what can we expect from today's committee hearing concretely?
So this is the first time that Becca will be speaking publicly since March the 10th, and that was when SVB was placed into receivership. So again, I guess we'll hear more details of what went wrong, but also there will be executives from Signature Bank. We'll have Scott Shea, the former chairman of Signature Bank, and other executives who will testify. And we already know from their written testimony that they say they believe that Signature Bank's liquidity position was actually, it wasn't too bad. I mean, it should have actually allowed the bank to stay open. But at the same time, they're saying that they understand why regulators took the actions that they did. So it will be interesting to hear both sides of that argument.
Stefania, thank you so much. Stefania Bianchi there with the very latest, of course, on SVB. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Treasury Secretary Janet Yellen says the U.S. is already paying a price for its failure to raise the debt limit. In a letter to lawmakers, she cited rising borrowing costs for government securities maturing in early June. Yellen also reiterated her warning the Treasury could run out of cash as soon as the 1st of June. House Speaker Kevin McCarthy, meanwhile, says the two sides are nowhere near a deal on the debt ceiling. Now, Microsoft's takeover of games maker Activision Blizzard has won approval from the European Union, putting the bloc at odds with regulators in the UK and also in the US. The EU says the $69 billion deal is pro-competitive and would kickstart the market for cloud streaming games. Microsoft is mounting legal challenges to the rulings blocking the deal. The US is preparing to buy up to 3 million barrels of crude oil to refill its strategic petroleum reserve. The country's emergency stockpile is at its lowest level since 1983 after the release of over 200 million barrels to curb high energy prices. That was last year. Deliveries into the government reserve are planned for August, with contracts to be announced in June. Bloomberg has learned that Amgen's deal to buy Horizon Therapeutics is to be challenged by U.S. federal regulators. The Federal Trade Commission is expected to file a lawsuit later today to block the $27.8 billion biotechnology deal on fears it could hamper innovation and slow the pace of drug development. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Thank you so much, Leanne. Coming up, we'll discuss the inflation headache facing European finance ministers as they meet for a second day. We'll be live in Brussels, and this is Bloomberg.
In today's environment where there's so much uncertainty in the economy, I don't think we can really rule out anything. If I had to have a vote right now, I'd probably vote to hold. But as you noted, we got 2 more inflation readings. We have a jobs report that's got to come out. There's a lot more information we're going to have as to what's going on.
We at the Federal Reserve probably have more work to do on our end to try to bring inflation back down. And most importantly, we should not be fooled by a few months of positive data. We still are well in excess of our 2% inflation target, and we need to finish the job.
Atlanta Fed President Raphael Bostic and Minneapolis Fed President Neil Kashkari on the U.S. Central Bank's next move to tackle inflation. Now, European finance ministers are meeting for a second day in Brussels. Let's bring in Bloomberg's Maria Tadeo from Brussels. So, Maria, good morning. Inflation, the biggest worry for lawmakers. What can they actually do about it?
Yes, it is, Francine, because on the one hand, when you look at the economic projections that were released yesterday by the European Commission for the spring forecast, they do say the economy is pulling ahead more than expected. There has been real resilience in services. But when you look at inflation, the story is not over yet. And in fact, you had 2 upwards revisions for this year and next. And by the end of next year, you'd still have inflation, if you believe the forecast, at 2.8%. That means still above the European Central Bank target. Now, when we spoke to finance ministers, but also in particular the German finance minister, he sounded downbeat to some extent, repeating, yes, the economy may be doing better than expected, but the job when it comes to inflation, and this is a #1 issue, is not done yet. Let's take a look.
Price stability is our priority. And then we want to prevent severe economic downturns. And so we have to coordinate the monetary and the fiscal policies.
And that was Christian Lindner, the German finance minister, speaking here to reporters in Brussels just a few minutes ago. And Francine, in some ways, he also encapsulates this talking points that we've heard repeatedly from finance ministers. Now it's the idea to really take a sober look at fiscal policy, because you don't want to counter the actions of the central bank. There has been a real stress about this coordination between the fiscal policy and the monetary policy. We know the European Central Bank has asked for tailored fiscal policy at this point to rein back some of that stimulus. The IMF is also calling for it. The question is, how are European finance ministers going to deal with that? Well, you know that for a lot of people in Europe, they still say they feel that pain when they go to buy things on the supermarket, when they see it on their everyday lives and the cost of living over the past year.
Yeah, I'll say, I mean, it's very, very tough across the board. So that takes us to the ECB. What are the implications for policy?
Yes, and Francine, we've already seen this downshift to 25 basis points. If you look to the future, obviously, there are a number of decisions that are coming up. You're looking at June 2. You listen and read the words of the Vice President of the European Central Bank, Luis de Guindos, on Saturday on the Italian media. He said, we've made that downshift. That is probably the new normal, so around 25 basis points. And we've entered the home run of monetary policy, perhaps suggesting and indicating that they have entered the next stage. But when you look at the market, they still predict there could be even 3 more hikes. Ultimately, you see that deposit rate that would peak at 3.75. And then, Francine, beyond that, and we talk about the lag between monetary policy, the actions taken by the central bank, and the feed through to the real economy, you see higher for longer, potentially no rate cuts until the back end of next year.
Maria, thanks so much. Bloomberg's European correspondent Maria Tadeo there in Brussels. Now let's also take a look at some of the key things that markets are watching out for today. 10 a.m. UK time, we'll get the German ZEW investor sentiment survey for May. Last month's reading showed outlook unexpectedly declining. Now at the same time, we're due to get preliminary readings of first quarter euro area GDP. 1:30 p.m. UK time, Canadian CPI data will be published. Also at 1:30, we're getting U.S. retail sales. And then later at 3 p.m. UK time, Fed Vice Chair for Supervision, Michael Barr, will testify before the House Financial Services Committee. This is important because Barr has been leading a review of the supervision and regulation of Silicon Valley Bank in light of its collapse. Now, coming up, we're joined by the Richmond Fed President, Tom Markin. That's also at 3:30 p.m. UK time. So that's going to be a fantastic interview, and we won't, of course, want to miss that. Oil demand will rise more than expected on the China rebound. That was our great interview with the IEA head of markets in terms of what that's doing to oil markets. Look, it has huge implications for what OPEC Plus could decide early next month when they talk about production cuts. Bloomberg Surveillance Early Edition continues in the next hour. Kriti Gupta in New York, Anna Edwards here in London, and this is Bloomberg.
You think about where the economy was and where inflation was last summer compared to where it is today, we've seen really positive things happen.
We should not be fooled by a few months of positive data. We still are well in excess of our 2% inflation target, and we need to finish the job.
It is foolish to try to pretend that one can forecast accurately. We do not know enough about the future to make those forecasts. What we need to do is to identify risks.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. China's recovery is quickly losing speed. That's leading to calls for more policy stimulus to boost growth. Not so great expectations. House Speaker Kevin McCarthy warns that the two sides are nowhere near a deal as he prepares to negotiate raising the debt limit with President Biden. And what's the latest 13F filings? What are they telling us about the US economy? Two billionaires' family offices bet on artificial intelligence, while Berkshire Hathaway dumps regional banks and wagers on Capital One. Lots to digest this morning. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. Some fascinating news around. We follow the debt story, of course. We've got data crucially around the retail space from the United States later on, the strength of the consumer in focus. But markets overall not reflecting any of the excitement, I suppose, Kriti, fairly stable.
Fairly stable. Look, it's a little bit of a litmus test today to see if that consumer momentum that really has been holding up the economy is still holding up the economy. Anna, you just talked about those headlines where you saw a lot of people saying, look, the Chinese data is slowing down a little bit. The debt data or the debt ceiling saga is ongoing with not really tangible progress. So nevertheless, futures are going to have a little bit of a negative bias right now, mostly unchanged. But that's really where the retail earnings could make or break the case for the U.S. stock market. So a little bit of a wait and hold pattern until we get those results starting in less than 60 minutes. And the two-year yield, though, continues to trade in that range as, again, we balance all of those different macro narratives. 398 on the two-year yield, already seeing a bid into treasuries, especially on the front end of the curve. That is a big deal when talking about where the direction of the dollar is going to go next, because once again, interest rates are now kicking back into the dollar story. It's not just a haven play anymore, and that's something we're going to talk with later in the show. The FX story continues to be front of mind as we digest everything that's going on in Washington, both on the fiscal front and the monetary front as well. NYMEX crude, our classic recessionary gauge, that's what I'm going to call it now, 71 handle. And I think the theme for today is technical ranges not going anywhere until we have real catalysts. At least that's the macro story. A lot more going on the micro.
Right, let's have a look at where the macro story takes us here in Europe then. We've just had some data coming through on the German economy. The German May ZEW investor expectations falling to minus 10.7. The estimate was minus 5. So this is a survey of the expectations of the investment community, and it's moving in a more negative direction, more negative than had been expected as well. So certainly worth keeping that in mind as we look at what's happening in terms of appetite for risk assets. This is what we see on stocks right now. It was a fairly positive picture, but not moving much, actually. So there was quite a bit of green on that map, but only slight gains. This is the Vodafone share price, down by 4.2%. This is a company that is taking restructuring action, cutting 11,000 jobs, we've heard from the telecom giants here in the UK. They have businesses not just in the UK, though, outside in Germany and in Spain, notably, and that restructuring activity will take place across some of those areas. So we'll watch for further details there. A relatively new CEO, although she's been with the business for many, many years. Telecom Italia, also in the telecom space, that stock actually not moving all that much right now, but the stock has been in focus as a result of, and was weaker earlier on, because they've seen a bid from KKR. They'd also seen a bid from Macquarie and a state-backed business. That state-backed business and Macquarie have decided to step away from the bid for Telecom Italia, and so as a result, we are not seeing any more expectations of bid activity, and so the stock slumps. The pound is at 125.27, pretty flat against the US dollar. It really dropped earlier on. So a few hours ago, we got labour market data around the UK, and the wages picture actually a little bit more mixed. But in terms of the payrolls, the number of jobs in the UK and the way that is changing, that dropped by an amount we haven't seen for a very long time. And that spooked markets. The slowdown in the labour market in the UK then seeming to loom large on people's radars. And that really dropped the pound. But it has recovered. It's now flat against the US dollar. Brent crude in here as well, Kriti. You had the WTI price. Here's Brent. We've got the SPR news flow, the Strategic Petroleum Reserves out of the United States, and also paying close attention to the growth story out of China. In the last hour on Bloomberg TV, our colleagues spoke to the IEA, and they were certainly talking about growth in China as a driver higher for oil prices.
Yeah, certainly something that we're still seeing, even though there are those macro concerns. You're not still seeing very much momentum, even a 0.3% gain, still not that significant. As we get a lot of those kind of signals from perhaps abroad, China, of course, is going to be part of that commodity story and the consumer story globally. In fact, their consumer spending and industrial activity grew at a much slower pace than expected in April, adding to concerns that growth in the world's second largest economy might just be losing momentum. We're joined now by China economy and government editor Jill Deeses. Jill, walk us through the data we got today. What are we taking away from it?
Yes, well, I think that that's right, that this was a lot slower than expected. Remember that we were comparing this data in April to a year ago when Shanghai was in lockdown. So already there was a really weak base for comparison. And we didn't even see some of these numbers match those expectations. Industrial output grew at half the pace economists were expecting. Retail sales spiked 19-something%, but ultimately didn't really match expectations there either. We saw a bit of a slowdown in fixed investment growth in the first 4 months of the year. So all of this is just combining with a bunch of recent data that we've also gotten out of China, whether that be really, really sluggish imports, export growth that hasn't been as strong as we would have hoped. The housing market hasn't looked particularly great recently either. Looks like it's kind of losing some of that rebound momentum that we saw in the first 3 months of the year. All of this is sort of telling us that there are some pretty serious concerns about the state of the economic recovery and that sustainability going forward. And so what that ultimately might mean is that maybe the central bank, Chinese policymakers have to revisit whether there's additional support that they might need to pull forward. That could be a rate cut by the end of the year. There's a lot of different options that maybe we'll need to consider exploring here.
Yeah, absolutely. I wanted to ask you about that, Jill. How do policymakers respond then to this data set? All the three pieces of data we just showed on the screen were worse than had been expected. So how will the PBOC and others react?
Yeah, so I think that that's ultimately what economists are looking for. There might be that the PBOC has some room to cut policy interest rates in the coming months. Remember, the Fed is likely to pause their interest rate hike cycle as soon as June. So maybe that gives the PBOC a little bit more room there. But we've also talked to some other economists who are saying there could be other policy measures that need to be considered here. Maybe that comes into the form of like subsidies or other kind of fiscal stimulus that can stimulate demand there, because ultimately this comes down to business confidence and household confidence, which just really isn't there yet for this recovery to be sustainable.
Jill Desis, creeping us on our toes, a crucial story in the China, even as we feel like in the last couple of years, perhaps we've started to see China and the U.S. on the economic front maybe diverge just a little bit, certainly folding back into the narrative. We thank you as always. Well, back on the economic front, sticking with that story, it's a busy week for U.S. retail as well. We're going to get Home Depot earnings before the opening bell today, plus retail sales data over at 8:30 a.m. Again, a litmus test for the broader economy. Bloomberg Simone Foxman joins us now. Simone, walk us through what the economists are expecting when it comes to the data first.
Well, we do expect U.S. retail sales to have picked up in the month of April to 0.8% from last reading's negative 0.6%, but most of that is going to be on the back of auto sales and gas stations to some degree. So when you strip those things out, we're going to get a much weaker number, something like 0.2%. And when you look at all of this retail sales data adjusted for inflation, the consumer is spending less on goods than they were during the height of the pandemic. And that's especially clear on an inflation adjusted basis. I think we've seen consumers switch to spending on services generally. Their expectations for inflation are very high. We saw that in the New Michigan Consumer Sentiment Index. And this is maybe our first read a little bit on what is happening in the second quarter.
Yeah, absolutely. A really interesting first read. We also get a kickoff on the string of earnings that we're going to get from big box stores in the United States today with Home Depot. What are we looking for there, Simone?
Yeah, the interesting bit about Home Depot as well as Lowe's, which reports next week, and as you said, there's a string of earnings coming out, is that home improvement stores among the big box retailers have been seen as a bit of a defensive play. They were really hot during COVID because people were staying home, they were improving their homes, and now people are stuck in their homes with bank rate saying it's 30-year fixed rate mortgages at 6.9%. But we do expect to see some same-store sales slow down. That is the broad expectation from analysts. We expect to see some margins contract on the back of higher spending on employees. Goods remain pretty high, but volatility is possible here. We tend to see a big move on this stock. However, I think when we look ahead to the next 10 days, really, of these retail sales, we expect to see some weakness among consumers. We expect to see them shifting into lower tier brands, whether that's private label or just simply higher cost brands. And we expect to see consumers spending less on discretionary and more on staples. Does that mean they're shopping at Home Depot? That's kind of the outlook we're going to see today. And last quarter, I should say, executives there, including Ted Decker, were pretty negative on the outlook. So anything a little bit more positive would be an upside surprise.
A little bit of a low bar for Home Depot, if you will. Bloomberg Simone Foxman, we thank you as always for walking us through that story. Certainly tradable. Again, less than 60 minutes till we get those earning results. Also going to be big movers in the stock market, the results of the latest 13F filings showing billionaire investing titans Stanley Druckenmiller and David Tepper loaded up on stocks benefiting from the artificial intelligence boom during the first quarter. Shirley Bassick, our global finance correspondent, joins us now for the details. So AI, huh? What's so great about AI? Why'd they get in?
We know that Stan Druckenmiller thinks about AI like it could be the next version of the internet in terms of the success through the next cycle. We also know that he believes that we are facing a hard landing ahead of us. That's according to remarks that Stan Druckenmiller made about last week over at the Sohn conference. Now, he increased his stake in NVIDIA. We know David Tepper of Appaloosa is also increasing his exposure to AI. When we look at Druckenmiller's holdings as a whole, though, I think it tells you a different picture about how he feels about stock picking as we head into that hard landing that he believes, selling out of 28 positions, adding 19 new ones. And so I think the net selling and buying pressure when you look at these big funds is very interesting. When you look at the whole community in aggregate on the heels of AI, as well as how we know technology is done overall, technology was actually the biggest sector increase among all of the 13F filings as collected and scoured by Bloomberg. And financials, no surprise, was the biggest sell. That is a big reversal from last year.
Right, and on that note, Shonali, very interesting because so there's AI and technology on the one hand, then there's banks on the other and financials. What do we know about Berkshire Hathaway and Warren Buffett's bets on the banking sector? He famously came to its rescue in 2008, at least in part. A more nuanced view, though, now of the regional banking turmoil.
Yeah, absolutely. Much more nuanced view. And I would point out, Anna, that he has been kind of souring here on the banking sector really before we even saw a lot of these banking troubles bake in. Think about last year when he really cut his entire stake in Wells Fargo after betting on that bank for decades. Now he is going a little further here. We are watching him step back from the likes of BNY Mellon and US Bancorp. His increasing of the holdings of Capital One is very interesting here, Anna. And why is that? Because Capital One, we saw them really increase their provisions for loan losses very, very meaningfully here in the last quarter after they reported earnings. They're only down about 4% on the year. We had seen their stock really react to Berkshire's buy pre-market. You know, an antithesis to Berkshire here a little bit was Michael Burry, where he did add a lot of the regional banks, including First Republic in the first quarter. So you're seeing, you know, very big differences here between Berkshire's long-term play and some of the more opportunistic trading you're seeing from Scion over there.
Shonali, thanks very much. Bloomberg's Shonali Basak with the latest on financials. And coming up, we'll talk to Esther Reichelt, Commerzbank FX strategist. We'll get her take on the dollar with the debt ceiling conversation continuing. What does she think will drive the dollar in that context? We'll also talk about the pound, big loser earlier on in session today, recovered from those losses. And later today, we will have an exclusive interview with the Richmond Fed President Thomas Barkin and also hear from the Chicago Fed President Austin Goolsbee. We spoke with the Atlanta Fed President Raphael Bostic in an exclusive interview.
Look, in today's environment where there's so much uncertainty in the economy, I don't think we can really rule out anything. If I had to have a vote right now, I'd probably vote to hold. But as you noted, we got two more inflation readings. We have a jobs report that's got to come out. There's a lot more information we're going to have as to what's going on.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York alongside Anna Edwards in London. Look, it's all about retail sales data today and then the retail earnings themselves. These next 10 days are going to be crucial for the American economy and really to see if the consumer is still spending. Are they still holding their own even in the face of this persistent inflation? We're still at a 4.9% reading. That does not necessarily bode well for people whose disposable income is withering slowly, which brings me to this chart. For our radio audience, stick with me. Basically, we're looking at retail sales both on a nominal basis and then adjusted for inflation. Now, going all the way back to as far as the data goes, the lines go pretty similar. You see this kind of steady increase, a decrease during COVID, and then a big pop. But then it diverges. And here's what's so important about it, because on the surface, it kind of looks like, well, retail sales are actually growing. Maybe the consumer is spending more. That's this white line for our TV audience. But then when you adjust for inflation, that's where you start to see this gap, a little bit more of stagnant, all the way going back from June to 2021. And that stagnation is what's concerning. Although, I got to say, on the surface, still good news, because even adjusted for inflation, consumers seem to be holding their own. There isn't that drop yet. Will we get that drop today? That's going to be the big question. Let's bring a little bit more market analysis to this conversation. Joining us now, Justina Lee, our Bloomberg Markets reporter. Justina, what do you make of this chart? For me, retail earnings are going to be that litmus test, but what else could shake this line?
Yeah, I think the question really here is how has consumer demand been affected by a year of monetary tightening? And I think that's going to be a really big question for people trying to read whether there's going to be a U.S. recession or not. Because on one hand, we're still seeing, slowing but pretty strong headline inflation number. But at the same time, we are expecting to see a bit of a kind of slowdown in retail sales. I mean, industrial production data today is expected to show a bit of a stagnation. And so I think the question for Fed officials here is really, do they think that a recession or like a contraction of that demand is going to come fast enough for them to not worry as much about inflation anymore? And kind of based on what we've been hearing so far is that, there are a few officials that say, okay, maybe we can pause right here. But maybe cuts this year have been too optimistic on markets' part.
Yes, we keep hearing from guests, Justina, who tell us that even if the markets are pricing it, they don't see the need for cuts. Not everybody, but we hear that often. I know that you've been thinking about the link between the markets and the debt ceiling fears, the way the markets will respond in the run-up to any X date. I've also been wondering about it the other way around, the role that markets play in focusing minds on getting a deal done. And if we did see a big move in markets, what would that bring to the table in Washington? What are your thoughts on the way that these two interplay?
Yeah, because if you look at markets right now, I mean, there are definitely pockets where you see anxiety of debt ceiling. I mean, most notably,
treasuries.
Exactly, yeah. Or like, the spreads of credit default swaps. I mean, that's actually for the U.S. above Greece or Brazil right now, which is pretty mind-boggling. And at the same time, there was a bit of a bump, in the T-bill curve. You see that the bills that are expiring after the X date are kind of getting that bit of bump in premium. But I think kind of overall, markets are not panicking. I mean, if you look at the fact that stocks have been like sideways, but not really too anxious. And if you kind of think about kind of treasury yield. So I think if we really get more bad news on that part, I mean, that will definitely kind of weigh on markets further.
Justina, thank you very much. Bloomberg's Justina Lee with thoughts on the markets. And for market analysis, check out MLIV Go. That's the function to use on your Bloomberg terminal. That's where you find the Markets Live blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. President Biden meets with House Speaker Kevin McCarthy and other congressional leaders today to try to avert a default. McCarthy says the leaders are nowhere near a deal to raise the debt limit. The standoff has been roiling markets as investors bet whether a deal can be reached. Elon Musk has been issued a subpoena by the U.S. Virgin Islands in a lawsuit over the late disgraced financier Jeffrey Epstein. Court papers say authorities had reason to believe that Epstein may have referred or attempted to refer Musk to J.P. Morgan as a client. Musk calls the idea, quote, idiotic. Wells Fargo agreed to pay $1 billion to settle a shareholder lawsuit. The plaintiffs accused the bank of making misleading statements about its compliance with federal consent orders. That was in the wake of the 2016 scandal over the opening of unauthorized customer accounts. Wells Fargo ended up paying $3 billion to settle the government probe. Bloomberg's learned that Morgan Stanley is considering a 7% cut in its Asia-Pacific investment banking workforce. More than 40 jobs are at risk. Deal-making has slowed down, especially in China, due to weaker economic growth and worsening relations with the United States. Anna, that continues to be a theme around the world, but the geopolitics, I think, is an interesting addition to just how discouraged perhaps a lot of these companies around the world, in Europe and America, are to actually enter not just Asia, but China specifically, which was making quite a bit of progress pre-COVID.
Right. I mean, this is a really interesting story, isn't it? Because it has that cyclical dimension around the Chinese growth story, but also the geopolitical dimension that you referenced, deteriorating relations between the US and China in the driving seat when it comes to this decision-making at Morgan Stanley. I should note that this is part of the 3,000 jobs that Morgan Stanley is cutting and that Bloomberg reported they are cutting earlier this month. So these aren't new numbers, but we're finding out a little bit more about the complexion of those job cuts, which I think is really important for those in the financial services sector. Now, coming up on the programme, we'll talk FX. Kriti, Esther Reichelt joins us, Commerzbank's FX strategist. We continue to look for developments around the debt ceiling. How will the dollar trade through all of that? A key question to tackle this week. We'll also ask about the pound, which has recovered somewhat from earlier losses. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. China's recovery is quickly losing speed. That's leading to calls for more policy stimulus to boost growth. Not so great expectations. House Speaker Kevin McCarthy warns that the two sides are nowhere near a deal as he prepares to negotiate raising the debt limit with President Biden. And what the latest 13F filings tell us about the U.S. economy, 2 billionaire families' offices bet on artificial intelligence, while Berkshire Hathaway dumps regional banks and wagers on Capital One. I'm Kriti Gupta in New York with Anna Edwards in London. Anna, a lot going on the macro front, even more going on the micro front as we kind of wait for some sort of direction from Washington, both on the debt ceiling saga, but also any developments that we're going to get from the G7. What it means for markets is a whole lot of nothing, it feels like. What are you seeing?
Yeah, certainly in a bit of a wait-and-see mode ahead of those debt conversations later and the data coming out of the US perhaps later on. Of course, the debt ceiling, the big talking point this week. The Stocks Europe 600 then, with that in mind, Kriti, going nowhere, as you mentioned, down by 0.1%. Most sectors have been in negative territory for this morning, although there have been some areas of brightness around technology, for example. Vodafone in the technology space is down by just over 4%. This is a business that under a fairly new CEO, she's been with the company a long time, but new in the CEO seat, is restructuring. They operate across Europe, not just in the UK, also Germany, Spain. They are announcing this morning 11,000 job cuts. Big restructuring exercise. The market unsure at the moment about some of the numbers as well. So the stock down over 4%. The pound is at 125.41, really recovering from being down 0.4% against the US dollar earlier on. We got this payrolls number that seemed to catch the market's attention in the way that it doesn't normally. Distracted us from maybe the unemployment rate and the wages conversation, which were maybe more complicated and still suggested a tight labour market. But that payrolls drop substantially into negative territory really sent the pound dropping earlier on in trade. And Brent crude is down by 0.4%, also turning around some strength of earlier on in the day. We've seen the strategic petroleum reserves narrative building in the US. They're topping up those stocks. That pushed the oil price a little bit higher, Kriti. And so that's certainly something we're watching, as well as the Chinese growth story. What do you see in the US markets?
Yeah, I think it's a similar theme, Anna. The idea here that when you kind of similar to the pound, that nitpicking of data to just kind of get any incremental hint about where the economy is going, that's what's going to dominate markets in a market that, by the way, is doing a whole lot of nothing this morning. Futures are relatively unchanged. Really, again, waiting for that retail sales data and to start the retail earnings that we're going to get in, again, less than 30 minutes. Two-year yield, 397, just shy of that 4% level. Remember, we are seeing a small bid into the bond market early on into the session, and that's marginally taking the dollar with it. But again, that strength you're seeing in the pound is going to be pressuring the dollar just a little bit as well. NYMEX crude, Anna, you hit at 74 on handle on Brent. The spread between NYMEX and Brent is widening, though. So you are seeing a 70 handle on crude, down about 0.5%. I love to look at the commodities as a little bit of a risk gauge. If this is any indication of how futures are going to be trading later into the pre-market session, it's not necessarily looking good, Anna.
Yeah, OK. So oil prices down, futures a little bit softer. Let's talk FX, though. We're joined by Esther Reichelt, Commerzbank FX strategist. And Esther, give us your thoughts on how the dollar performs here, because, of course, the debt ceiling debate is the big subject in Washington. It is having an impact on some markets, not necessarily stocks, and arguably it is having an impact on treasuries. What is it doing to the dollar? What should it do to the dollar in various scenarios?
Well, that's a super interesting question. And I think this uncertainty about this question is what's currently driving the market. I mean, I guess everybody was a little bit surprised about the US dollar actually appreciating despite this US debt ceiling debate. I mean, there are some comments about this whole risk being priced out, looking at this low volatility levels and so on. But this does not really fit to the news flow we get. So, and I think it does more indicate that the market is actually leaning towards a stronger dollar or to go in with a stronger dollar into this whole US debt ceiling uncertainty. Because there is a huge uncertainty about how markets will actually react if we might see a hypothetical default, because it's not about the US not being able to pay their debt, but rather about, like for political reasons, not wanting right now. And given this uncertainty about how markets react, it's always good to have the US dollar because it's a safe haven. It's one of the most liquid assets. And I think that's what we are actually seeing right now.
Esther, it's the no-brainer, it feels like, to do the dollar call. But I have to say, are you worried at all about it becoming a crowded trade? I believe the Bank of America Fund Survey said that tech, shorting regional banks, and then at the end of the day, the dollar are the most crowded trades there are in the market right now. What would change your mind?
Well, absolutely. I mean, I'm very concerned that this US dollar strength we're right now seeing is just due to this whole, basically traders not knowing what to do. And this sentiment could shift very easily because the risks right now are clearly on the US dollar side. Concerns about regional banks' performance in the United States, this whole debt ceiling debate. This could easily shift against the US dollar. But right now, everybody's looking what everybody else is making, and the US dollar trades strong. This could easily shift with some more concrete negative news on the debt ceiling debate, maybe later today. But I guess the likelihood of this shift against the US dollar sentiment will increase the closer we get to this actually debt ceiling or default deadline.
Okay, yes, so we'll continue to monitor it and check in with you perhaps the closer we get to June 1st then, Esther, if these conversations continue. Stepping away from the dollar dynamic and to the pound, a few hours ago we got this data out of the UK labour market and the payrolls number, which isn't a number that seems to get a lot of attention from commentators usually and from economists, and yet that seems to be the thing that was driving weakness in the pound earlier on. The pound has recovered a little from that, or entirely recovered from that. I wonder what you make of that data set this morning.
Actually, this data today basically confirmed my view that, the market is expecting the Bank of England that the Bank of England wants to do a rate pause rather sooner than later. So any data indicating a cooling of the economy, they jump on, trade the pound weaker, pricing out interest rate hikes. However, it's pretty clear that inflation is still very high at the UK. Inflation risks continue. And I mean, if you look at the wage increases, they are still strong. So this still indicates that the Bank of England has to do more. So what we see is the Bank of England is rather reluctant, waiting for the possibility of a rate pause. But of course, nobody doubts that the Bank of England will do what is necessary if there are inflation risks. And this mixed data, therefore, is also reflected in a very mixed pound sterling performance. Everybody's shifting between, okay, so this is arguing for a rate pause, or rather, well, the Bank of England actually has to do more, which is, of course, then supporting the pound sterling again.
Esther, I want to go from the G10 story to the EM story and very casually avoid the pound as an EM currency joke that there is. I want to talk to you specifically about the lira here and whether or not, in the absence of any real direction from a lot of these G10 countries, where you are essentially navigating the same stories, inflation at the end of the day / debt ceiling. Is there an extra incentive to perhaps take on a little bit more risk-taking into the EM FX world, perhaps a little bit more incentive to trade a currency like the lira?
Oh, well, definitely not right now. I mean, we are heading towards runoff elections in Turkey. There was a huge disappointment by international investors, which had hoped for a more market-friendly government, and which does not seem to be the case right now. I guess for Turkey, actually, it's very difficult to trade it at all. The exchange rate is still very steered, and there is a strong incentive of the Turkish government to keep it stable until the runoff elections. But it's also clear that there is a huge depreciation pressure. So Turkish lira basically seems like a one-sided trade, and it's difficult to get onto the other side.
Esther, very quickly, I want to talk to you. Actually, you know what? We're going to wrap it up there, but we thank you, as always, for joining us. We really appreciate it. Really covering the gambit when it comes to FX and the story there. Esther Reichelt of Commerzbank, we thank you, as always. Atlanta Fed President Raphael Bostic says he's starting to see the Fed's policies to fight inflation take hold, but not to rule out any more surprises. He sat down for an exclusive interview with Bloomberg's Michael McKee.
When I think about the trajectory of inflation, I think that we've made a really good progress on that. If you think about where the economy was and where inflation was last summer compared to where it is today, we've seen really positive things happen. We're not at the 9 and 10% levels. We're in 4.5 to 5 range. Now, look, that's still two times what our target is. So there's still a ways to go. But I do think that we've seen a lot of some of the froth really come out of the inflation measure. You know, one of the things I look at, one of the measures I try to keep track of is the number of goods in the basket of this that's used to calculate the CPI that are showing inflation above 5%. Right now, in the latest report, that came under 50%. Less than half now are in that range, where at one point it was 70 or 80%. So I think we're seeing that breadth narrow, and that's a really positive sign. So I think we are starting to see our policies really work.
But do you rule out any more additional rate increases?
No. Oh, no. Look, in today's environment where there's so much uncertainty in the economy, I don't think we can really rule out anything. Look, I think we are in a place now where we've been in restrictive territory for something like 6 to 8 months. That's about the time you'd expect to see our policies start to bind on the economy. And when I talk to businesses, they tell me they're starting to feel that bind, and that's a really positive thing. But as you know, we've had surprise after surprise after surprise over the last few years, and most of them have been to the negative when it comes to getting closer to our inflation target. So I've got to keep that on the table for sure. But right now, I'm feeling like let's see how our restrictive policy is working, and that'll give me a sense of what our next move needs to be.
Well, you still have a PCE inflation report and a CPI.
We got 2 more, exactly.
Before your next meeting. What are you thinking now, though, for the June meeting?
Well, if I had to have a vote right now, I'd probably vote to hold. But as you noted, we got 2 more inflation readings. We have a jobs report that's got to come out. There's a lot more information we're going to have as to what's going on.
Atlanta Fed President Raphael Bostic speaking with Bloomberg's Michael McKee. Now, later today, we'll have an exclusive interview with the Richmond Fed President, Thomas Barkin, and also hear from the Chicago Fed President, Austin Goolsbee. Coming up on the program, Macron's EV pitch, how the French president is trying to convince Elon Musk that France is the next big place for Tesla. More next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Allianz Chief Economic Advisor Mohamed El-Erian. That coming up at 9 a.m. New York, 2 p.m. London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. Now, the French President Emmanuel Macron is looking to woo investors to the country with his Choose France event that's been taking place, turning on the charm offensive with Tesla CEO Elon Musk in the Élysée Palace on Monday. Macron is hoping to make northern France a hub for the production of electric car batteries. Bloomberg's Oliver Crook joins us now for more. And Oliver, you've, of course, been very close to the auto story across Europe. What did we get from that meeting that took place at the Elysée?
So apart from that pretty awkward video that you just showed, you got some sort of vague commitments. You had Elon Musk saying to Le Maire, actually, that he will probably make a significant investment in France at some point in the future. So from that standpoint, nothing terribly concrete apart from this sort of agreement. But, you know, you can understand why France wants this. In Germany, Tesla employs 10 to 11,000 people. They have a factory, a Tesla factory just outside of Berlin. But this prompts a couple of questions. One, how will the French car makers react? Already, Tesla's blowing up the whole model for the auto industry and legacy auto automakers. And Musk, though, is someone with a rather sizable appetite for challenges. Is that appetite large enough to take on French labor laws? Musk is not exactly known for being someone that believes in a sort of work-life balance reputationally. And obviously, just a few weeks ago, you saw, Paris burning because Macron was trying to reform the labor market. So these are some of the questions, I think, going forward for it. But again, this is really part of Macron's bigger plan to attract more business. And again, it is still actually quite an attractive place for business if you look at the EY surveys in terms of attracting foreign investment. In Europe, it tops the chart.
How does that square then with this kind of massive push for the EV, the electrification process? Because he also was very vocal when it came to President Biden's Inflation Reduction Act and being competitive. How is this being received by his international peers?
So for Macron and for Europe more generally, you have this situation where Macron is talking about reindustrializing the economy. So the French economy is only about 9% industry. In Germany, that's close to 20%. And so you really, though it may not be the biggest companies, actually the biggest companies in Europe, as you know, is in France. It's LVMH. But its revenue is 30% dependent on China. So this is all about reducing dependencies from externally, but also creating, stimulating the economy that actually employs people. Volkswagen has more than 600,000 employees. LVMH is like around 100,000. So it's all about developing this and reindustrializing the economy. And he's walking a fine line, though, because he's talking a lot about we need to produce in Europe, we need to put Europe first. But the name of this event yesterday was Choose France, right? And he brought 200 business leaders and he got $13 billion worth of investment. But this is a bit of the line that you've got with the state aid rules rolling back, and it's going to be sort of a conflict for Europe going forward.
Okay, so he's talking to Musk. He's talking about Tesla. Tesla has feet in various parts of Europe already then, Oliver. What about the AGM that's taking place at Tesla today? What's going to be in focus there?
That's right. I think one of the main things that's going to be in focus is Musk's strategy that is really he's developed over the last couple of quarters of price cutting, of putting volume over margin. And this is a tactic that investors have not necessarily rewarded. And you saw it double down even yesterday. Yesterday in Germany, Tesla has cut prices additionally to those who are buying fleet, large bulk Tesla. So right now for Model 3, you get about 30% off for these fleet things with all of the subsidies and 25% off for the Model Ys. That's definitely going to be one of the questions. Investors are not necessarily convinced about the strategy, at least not all of them. You also had the story on Friday that was a bit buried. They had to recall basically all of their cars in China for a software update to deal with the braking. That's 1.1 million cars, so that may come up. But then again, there's also this question of, is Musk too distracted? So maybe the appointment of a new CEO at Twitter helps us out there. But there are already shareholders that are saying that they want a meeting with the board to discuss CEO Elon Musk's performance. So all of this to watch for the AGM later today.
Okay, we'll keep that in focus then in terms of the auto space. Thanks so much. Oliver Crook joining us there from Berlin. Coming up on the programme, back to one of the things we talked about already, the strength or lack of for the US consumer. Home Depot is out with its earnings report shortly. We will get a preview next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Let's get a look at some of the stocks we're watching in pre-market trading in the United States, starting off with Warren Buffett and the companies. Berkshire Hathaway has chosen to up their stake in HP and Capital One, already cashing the Buffett bid this morning. This is really important as we see Berkshire Hathaway kind of returning to a little bit of the old guard, dumping some of the regional banks, instead going to some of the classics. Capital One Financial, HP up about 1.5%, Capital One up about 6% as well. He's not the only investor we're keeping an eye on, though. Michael Burry getting his bets as well. This time, not in the States, though. It's abroad. Alibaba and JD.com, although both kind of dropping from that overnight Chinese data, they are on Michael Burry's radar, both dropping by the tune of about 1% and 0.6%, respectively. You look at his portfolio, though, almost 20% of his portfolio is just those two names, Alibaba and JD. So he is getting that exposure to the Chinese internet story. That's going to be really important. As we talk about the tech story, let's talk about the tech story right back home, and specifically in biotech. Amgen right now, their $28 billion deal for Horizon Therapeutics, well, it's getting challenged by the FTC, and that is a really big steal in the biotech space. Amgen shares higher by 0.6%. Horizon, on the other hand, the target taking a little bit of a hit, down about 17% in the pre-market. But again, all eyes on those retail earnings. We are in the countdown to Home Depot reporting ahead of the opening bell today. Analysts warning their results may just show a little bit of pain, signs of weaker consumer spending. The shares are already down about 0.3% in the pre-market. Drew Redding, Bloomberg Intelligence analyst, joins us now on what to expect. Drew, thank you as always for waking up early. What is on your radar? What is the gauge of success for Home Depot?
Sure. So I think it's important to first point out that Home Depot has been on an amazing run the last couple of years, but we think that some of the tailwinds that they've benefited from during that time are starting to fade a little bit. And the most important one is the trends we're seeing with the consumer. So from the macro perspective, you have still high inflation, you have real wages, which has been pressured for the better part of a couple of years, and you've got credit card debt, which has started to explode. So it's kind of showing the pressure that the consumer has been under. But at the same time, at the company level, Home Depot's facing challenging comparisons. They've got commodity deflation. They're facing some weather-related challenges. And most importantly, and something that we're looking at for the remainder of the years, we think we're going to start to see a more of a moderation in big ticket spending. And that's really what's driven the home improvement retailers over the last year.
Drew, good morning to you. So we could see the weather having an impact here. We could see a pullback in consumers' enthusiasm for those big ticket items. What about conversations, though, around whether you move or improve? So if the housing market is looking difficult to navigate, you might decide to do improvements. Does that act as a bit of a buffer to a company like Home Depot?
Yeah, we certainly think that that has been a big driver of their success recently. They'll tell you that home improvement space has decoupled from its traditional relationship with housing turnover in the existing home market. Now, typically when you think of housing transactions, when you put your home on the market, and then, as soon as you make a purchase, you tend to fix them up. But because there's been such a lack of mobility in the market due to higher interest rates and generally weak affordability, we have seen people stay put and make investments in their home.
Drew, talk to us a little bit about the backlogs that we're seeing, but same store comps. And we're talking about these specific kind of metrics. Which one is going to be top of mind for you?
So certainly everybody's going to be looking at the trends in same store sales. The consensus is for a low single-digit decline this quarter. We think that there could be some risk to that due to some of the factors we mentioned. But more importantly, I think there's risk for the full-year outlook. Home Depot guided to about flat same-store sales during their last call, and that outlook kind of assumes that the broader home improvement market declines only in the low single-digit range. And when we look at our expectation for the market over the next year, we're kind of thinking that the market is down anywhere from 5 to 7%. So we think that there is downside risk to the full-year outlook, and I think that's something that investors have been kind of latching onto, is that while you saw Lowe's be a little more cautious in their outlook, Home Depot has kind of maintained a little bit of that enthusiasm by keeping their comp guidance flat. So we do think there's some risk in that regard.
Drew, thank you very much. Drew Redding joining us there from Bloomberg Intelligence, and we'll certainly stay tuned for those numbers due from Home Depot imminently. That is it for Early Edition. Surveillance is up ahead. Tom, John and Lisa will be with you. They'll certainly be talking you through the corporate earnings stories as they come in. They'll be hearing from Tiffany Wilding, Chief Economist at PIMCO. They'll be getting a take on the US consumer through those corporate earnings, but also the retail sales numbers. They are due later on today. That's the data point of the day. And, of course, building towards that debt conversation in Washington later on today. We'll see what comes of that, if anything. Do we have to get closer to X date to see any progress? Stay with us. This is Bloomberg.